let's look at these questions. They're pretty straightforward. Doing a general definition of IRD, and this, again, guys, you can take it straight from the regulations. IRD represents an amount owed to the decedent for which no material acts are required of the decedent, and that if the decedent had lived to collect the amount, the decedent would have reported such amount as gross income on the decedent's income tax return. So it represents an amount owed to the decedent. There were no material acts that the decedent were left to had to perform. And if the decedent had lived to collect the amount, the decedent would have reported on his or her final 1040. For examples of IRD, well, there's lots of examples of IRD, you guys. We covered compensation in the form of wages, vacation pay, sick pay, severance, bonuses, deferred compensation, dividends declared but not yet paid, accrued interest, accrued rents, royalties due but not yet paid, qualified retirement benefits, proceeds from a sales contract. All those are examples of IRD. What makes post-death bonus awards different from other types of IRD? And the big difference is that there's no legal right? And although it's not here, but there's no guarantee that they don't have the exact aroma of being IRD, but the courts have construed it as such. At his death, James had a binding contract to sell a building for $1 million, and at the date of his death, all material actions had been taken other than the closing. What tax uncertainties might arise if the buyer in James' estate terminate the contract? So, is this an item of IRD?
I would say no, because the buyer terminated the contract.
Well, they're doing a solution, and our intention in putting together this question, notice the use of the phraseology, all material actions have been taken.
So
there's nothing left to do here. In my perfect world, I mean, it's a little bit ambiguous, but our position would be, as the authors, that we would make this an item of IRD. So 1014 would not apply.
Yeah, but if you never received the proceeds, they never paid you.
Do you have a right to sue them for breach of contract?
Well, it doesn't.
I don't know. So, I mean, this is one of those things there's some ambiguity about, right, Karen? Not going to be a good multiple choice question. Let's look at the next question. Mark is the sole shareholder of a successful corporation. Mark, as the sole shareholder, adopts a plan of liquidation and files with the state secretary of his state an intention to dissolve, thereby obligating the corporation to cease doing business and distribute its assets to its shareholder. Mark dies before the corporation is liquidated. Its stock of Mark's Corporation is the stock of Mark's Corporation an item of IRD. Okay. Now, just keep in mind there's two code sections that could trigger when someone liquidates a corporation, there's possibly two levels of tax, just to remind people who had corporate tax. Tax at the shareholder level is Code Section 331. There's a tax possibly at the corporate level, Code Section 336. So, given that, now, if the taxpayer dies owning the shares, right, and the company is subsequently liquidated, Code Section 1014 applies, right? And there would be no tax at the corporate, at the shareholder level. So let me just give you an example that if a corporation owns a building with a basis of $400,000, fair market value of $400, basis, fair market value of $1,000, right? Corporation owns one building, owning, you know, and the shareholder has one share of stock worth $1,000, right? Basis of $400. The share, again, the corporation owns this. And here's the shareholder owning one share of stock with a basis of 400, fair market value of 1,000, right? If the shareholder dies owning that one share of stock, what's their executor's basis now in the corporation? $1,000, right? Fair market value. So when the corporation liquidates, there's no gain or loss, right? If the base equals fair market value, right?
Right.
The corporation would still have a gain of 600, right? That's code section 336. But the shareholder wouldn't, code section 331. So the question is here, now, if the company liquidates, there would be, again, we can't get rid of the corporate gain. The corporation on its final 1120 would pay tax on $600. And if in a normal circumstance, if the shareholder gets this real estate, under code section 331 would pay gain on $600, right? So here again, is this IRD, or should code section 1014 apply? Just so you know, there's a court decision cited in our material. I'll spell for you S-I-D-L-E-S. I'll repeat, S-I-D-L-E-S. This is the exact fact pattern in that case. You own all the stock and adopted a plan of liquidation, and the plan was approved. Later in the year, the company was liquidated and dissolved, but he had died before the time that the corporation's assets were distributed to his estate. The majority held that the proceeds paid to his estate were IRD, on the basis that, right, that is the basis that Harry's affirmative vote for liquidation created a right to receive a distribution, which right existed at his death. The majority of opinion also said, although the decedent had the power to rescind the transaction creating such a right, he had not attempted to do so before his death. The dissenting opinion would not have found IRD because, in their minds, the key question was whether the redemption or liquidation had proceeded to the point beyond the control of the decedent prior to his death, and they focused on the fact that he could have rescinded. Carlos?
Is there a certain time period for the rescinding?
I'm sorry?
Is there a certain time period he had to rescind?
Anytime,
Before
a
that.
moment before, because he was the sole shareholder.
Or I was just wondering if it was like a 30-day and then you died, like, okay.
Anyway, again, emphasis on, these are not easy cases, guys, but again, along a continuum, we know sometimes definitely 1014 will apply, sometimes code section 691 will apply, and there's going to be some real tough cases right in the middle.
So in this example, the question is whether, like, the type of control that he had prior to his death, so that will be the deciding factor on whether or not he's going to be taxed or not taxed.
Right, if there's anything left to be done, if there's nothing material to be done, we're going to say, hey, that's an item of IRD. If there was some things that needed to be done, and they weren't done, meaningful things, and he dies, then he died owning the property because at the moment of his death, he really still had title to the property. He didn't have a right to income, he owned title to the property. Okay, so beginning on page 14, there's a discussion of IRD taxation. So, guys, you know the drill. We've now identified, just like with the grantor trust status, and this is common, right? Identification, right? Once you make identification, that's good. Proper identification is worth its weight in gold. You make the identification now, let's talk about the tax implications. Who is taxed? Okay? Who is taxed? And it's a menu. Got to fit within the parameters of A, B, or C, or 1, 2, and 3. So IRD is taxed and only taxed to 3 different possible parties. The decedent's estate, that the right to receive the amount is acquired by the decedent's estate, the distributee of the estate, or a non-probate distributee. A person, by reason of death, acquires the right to receive the amount, but is not acquired from the decedent's estate. And this is typically, if you don't mind me making an observation, item 3 is typically retirement accounts, right? Those are not probate assets. They're outside the probate process, right? There's a beneficiary designation, and it gets paid directly to a beneficiary, but it's still IRD, right? It's just not going through the decedent's estate. Agreed? But if someone says, if the decedent says, in the decedent's will, I give all my stock and any dividends thereon to my son Alfred, and Alfred gets the dividends, right? To the, there were dividends to be paid on the stock. Well, that's the second item, right? Those are items of IRD, and they're going through the probate process. I'm just making a practical point here. Retirement funds, do you want them payable to your estate or payable to the beneficiary, and why?
Beneficiary.
Why did the beneficiary
Because
pay?
it's not included in the state, so it doesn't.
No. Code section 2033, retirement beneficiary. If you have an indicia of control, it's still includable in the decedent's estate for estate tax purposes. So why would you not make, why do you make the beneficiary your spouse or your children, and typically you don't make it the estate?
Snap-on basis.
Say again?
Snap-on basis.
No, definitely not, because we know code section 1014C, you don't get a separate basis, so that can't be the motivation.
Is this because if a wife or husband inherits retirement account, they don't have to withdraw the money right away,
They can roll it over, right?
Based on the distribution of the money, if you go to the state, will not count. They have 10 years or some years.
5 years.
5
You
years.
pay
Yes,
to the estate just
so
5
you
years.
cannot get more. So they have to distribute within the 5 years.
Right, so if you name a beneficiary, like a child or grandchild, you get what's called a stretch IRA, right? You can take it over the actuarial lifespan of that person. The minimum distribution rules are found in code section 401A4, right? When you turn 70 and a half, right, you have to start drawing down your retirement account. Everyone agree? But suppose the person or someone dies, if they make it payable to the estate, it's got to be paid out within 5 years. But if it's paid to a child or grandchild or whomever, that person can use their actuarial lifespan and achieve a stretch benefit. Now, will this be around for the next 50 years, like the charitable trust area? My Jay Sol's opinion, I would not, were I Congress. This is, who are retirement benefits designed to, how do I say, retirees, right? They're supposed to be the ones who get the benefit of the tax-free growth and whatnot. And I get spousal rollovers because husband and wife in our country are treated as one economic unit often, right? Is there any reason other than the power of the financial institutions for us to have stretch IRAs? I ask rhetorically. No. I mean, that's my. So anyway, I'm just telling you as you're going through and thinking about retirement accounts and IRD, often just make sure for your clients that they do not have the estate named as the beneficiary. It seems, in theory, you're like, oh, let's keep it simple. Not so quickly, okay? Because you don't want an email going out from your office saying that, or just saying, oh, that's good, or that's okay, because I've seen lots of children be very upset that their professional let that slip through. By contrast, with respect to life insurance proceeds, are they items of IRD, life insurance proceeds? Simone? Why not? What's your authority? Say it loudly. 101. 101A. Life insurance proceeds are not IRD because they are exempt from tax, income tax, right? So look, guys, you can go through our examples here of monies being paid. I like to think, maybe I'm deluding myself, added to my long list, that these examples are pretty straightforward of monies that constitute IRD, and they're not very complicated. I will point out that on page 17, that if you go to the second full paragraph on page 17, any transfer broadly defined to include a sale, exchange, or other disposition of an IRD right results in taxable recognition event to the transferor. The income recognition event is equal to the fair market value of the IRD right at the time of such transfer plus the amount by which any consideration for the transfer exceeds such fair market value. So if you do, or someone attempts to transfer an item of IRD, you can accelerate the gain recognition. Accelerate the gain recognition. And there's an example of that, a few different examples. When you guys read, we'll go through some examples I have, all right? We don't need to get too enmeshed in this. So look at the questions on page 20. We're the only persons allowed under 691 to recognize IRD. And we talked. They only come in 3 flavors that's spelled out at the very beginning in this segment of the chapter. Question 2. John has deferred compensation agreement with his employer that provides for John to receive $50,000 if he's still employed at the time of his retirement. It also provides that if he dies before his retirement, his employer will pay $50,000 to his surviving spouse. He doesn't have a surviving spouse to his estate. John dies prior to his retirement, so he had a right to the income, right? That's a contractual right. So we know it's IRD, right? There's no more material things that John has to do. He has a right to the income. John has no surviving spouses, and employer pays $50,000 to the personal representative of his estate. So who gets taxed? The estate, right?
Yeah.
The estate will report it on a Form 1041, right? John has no surviving spouse, and the personal representative assigns the right to receive the compensation to the residuary beneficiary, the company pays $50,000 to John's residuary beneficiary. So,
Estate still.
B, what do you say to the estate?
Plus the beneficiaries aren't supposed to be taxed
It's
here?
not on the list.
Oh,
Residuary beneficiary is not on the list of the things that can be.
Well, why can't the estate assign it? I'm assuming that was what the decedent wanted, or else I would never, let's put it this way, no personal representative is gonna put themselves out there. So if they assign it to the residuary beneficiary, again, that's a
That was
permissible
number
class.
2? This
Yeah,
should
that's
be-
number 2.
Ah, okay.
oh, okay.
So then the residuary will be taxed.
The residuary beneficiary would be taxed. How about John is survived by his wife, Jane? His employer pays $50,000 to Jane. That's pretty straightforward. Who's gonna be taxed there, guys?
Jane.
Jane. John is survived by his wife, Jane. Jane assigns the right to $14,000 of this compensation to her son, Tom, and assigns the right to $14,000 to her daughter-in-law, Mary. John, an employer, pays $22,000 to Jane, $14,000 to Tom, and $14,000 to Mary. Okay, the total is 50. Who gets taxed on this?
Gee,
Jane should get taxed in the entirety because of she's assigned it away. She's transferred it, and they're not permissible here. This is under Code Section 691A2.
Couldn't she gift that 14,000 to her, kids?
I'm sorry?
Couldn't she gift some of that money to the?
She could, but she's still taxable on it.
Yeah.
So she's taxed on all 50.
It is.
She's.
All right? Now there's a question of, we now know who is taxed. Now there's a question of when is it taxed. And we point out that the mere existence of IRD doesn't generate income. There's got to be one or two events. It's got to be collected or it's got to be transferred. So the mere, again, let me say that again. The mere existence of IRD does not trigger tax. It's got to be collected or transferred, okay? And we just saw an example of mom transferring it. That's going to give rise to her being taxed. So you can look at the examples spelled out on page 22. Just keep in mind, and for a lot of you, this is antithetical to your way of thinking, because you're used to me saying you get rate carpet treatment when you make a transfer to a corporation or a partnership. If you recall, you have Code Section 351 and Code Section 721. Both of those code sections negate the application of Code Section 1001. So, generally when you form a partnership or corporation, no tax. Everyone agree? However, this is one of the rare times where if you transfer an item of IRD, guess what? It doesn't work. Okay, why? Because, Congress doesn't want people to circumvent their tax burden by transferring it into a partnership or corporation and essentially indirectly having others taxed on it. All right? Now, we're not going to get into the details, the muck of installment sales, all right? But sometimes someone, prior to their death, sells property, they get an installment obligation, all right? And the installment obligation obviously constitutes an item of IRD. let me just make an observation too about an installment obligation. That if you sell property and you get back an installment obligation, and you sell or transfer your installment obligation, barring certain exceptions, that you can accelerate the income recognition on the installment. In other words, selling something on the installment method triggers the application to Code Section 453, which allows you to take the gain in piecemeal. But if you do transfer the installment obligation, again, barring certain exceptions, that you can trigger or accelerate is the better word, gain recognition. What's my authority for that? Code Section 453, capital letter B. All right, Code Section 4. So similarly, in this context, the transfer of an installment obligation by the recipient of IRD can trigger an acceleration event, okay? We're not gonna get, and I'm not gonna ask any real questions about installment obligations because that's a whole nother course about that methodology. So there's two quick questions here. What two events will trigger IRD recognition? We know collection of the IRD or transfer of the obligation. Okay, transfer, or collection. Now, assuming there is IRD recognition, when is it recognized? It's the year it's received or the year it's transferred. The year it's received or the year it's transferred. Page 25 goes into a description of the amount received. 99.9 times it's going to be equal to the amount actually received, less if there's any DRD, any related deductions. Karen, go ahead.
I just had a question quickly on the non-taxable transfers. Can you just explain that a little better? I don't really understand. Why can you keep doing this indefinitely? What are they doing differently in the non-taxable transfers versus?
Well, when you say non-taxable in the context of partnerships or corporations?
No, page 22, you said non-taxable transfers, that's the first thing. It's not a transfer that triggers IRD recognition, the transferee steps into the shoes of the transferor of these non-taxable transfers.
Well, just, let's slow down, Karen. Non-taxable, are you talking about the first paragraph?
Yeah, on page 22.
So you're talking about non-taxable transfers, okay?
Yeah, I just didn't see
Okay,
what
let me
exactly was
just
the
get
difference.
back into the context here, give me 1 second. I'm not quite sure if I understand your question, but just keep in mind that it can cast IRDs as long as it's within the parameters of the permissible beneficiaries, can, assuming it's consistent with the decedent's intentions, cascade. And look at the example that we have here. Someone dies and the item of IRD, say it's a bonus amount, okay? That we know is an item of IRD, can be transferred into a testament. So you assign, let's suppose the person leaves their residuary estate in a trust, Karen, you're the surviving spouse, okay? I die, I'm married to you, I bequeath my bonus right into a testamentary trust for your benefit, but again, it's a trust for your benefit, right?
Okay, so it's always this other entity, not a specific person.
Not a specific person,
Like
but
the difference between what Dean did with whatever he gave it to her 2 kids or whatever.
But
This is
those
getting
are
out the
not-
collection of cash. This is just saying, well, that bonus seems a little different. I can see if you just, oh, here's your IRA account, and you never start drawing it down, you keep passing it to somebody until somebody actually draws it down. Is that what you mean?
the assignees have to be within the my ambit of who, if you go back to permissible beneficiaries under 691A,
Well, I just didn't have it continue indefinitely, but okay, it's just too complicated, we don't have to keep going on it.
all right, the point is, they have to be within the ambit of permissible beneficiaries, then it can keep cascading downward, and not being taxable. All right, so, page 25, we talked about the amount recognized. Generally, like I said, it's going to be the physical amount received. So the questions here: what are the tax consequences to when a decedent bequeaths an installment obligation to the obligor? And here is a common one that people people enter into installment arrangements with their children, is what I've seen, where dad sells something and the child agrees to pay dad off for the house or picture, whatever you want, some sort of installment obligation where the child agrees to pay the parent X dollars over, say, 10 years. And the parent dies and says, under the terms of the will, you know what? You no longer have to pay me that installment obligation, right? It is extinguished at my death. There is case law that says that extinguishment of the installment obligation will trigger an income IRD, okay? The extinguishment will trigger an obligation, excuse me, let me flip that around. I'm right. If you look at the example above, you sold property before a cash method's debt, taxpayer's debt. You sold property for $100 installment note. We paid $10 cash increments over a 10-year period. The taxpayer's basis of the property was $90. Upon his death, neither the $100 receivable had been received, nor was recognition required. And the little language of 691A2, if the taxpayer's estate sells the installment note, hold on. There's the gain of $8. I apologize. 1 second.
It happens sometimes, actually.
I'm sorry?
No, I had a piece like this, that the grandson had a loan from grandma.
Okay.
She died, and there's still some money left.
You mean the grandson still owes the money?
Yeah, so he will have to pay tax on the net loan, not including interest.
You know what, I'm gonna skip this for our purposes, because there's actually something called cancellation of indebtedness income that this gets into that I'd rather not get into. Let's look at question 2, because it's a lot easier to follow. Question 2, suppose the taxpayer sells his $1 million business for a 10-year installment note, providing for annual principal payments of $100,000, okay? So we've got 10 payments, $100,000 a piece. The business consists of appreciated inventory and machinery. All right, so everyone sees the inventory has a basis of 200, fair market value of 400. The machinery is appreciated. It's the 1231 asset, right? Before the first payment is even made on the installment note, unfortunately the taxpayer dies. How much income must the taxpayer report on his final income tax return? Okay. Well, this is a quintessential item of IRD, everyone agree? So there is no income to be reported, right? Does the installment note receive a basis equal to fair market value? And the answer is no, right? Because of Code Section 1014C. So In this case, the taxpayer's estate receives the same basis the taxpayer had, or $300,000, right, in the note. Everyone agree? Look at the basis the taxpayer had, right? Everyone agree the taxpayer had a basis of $300,000? Thus, the amount recognized by the estate is $680,000. That's the sales price of $980 less the tax basis of $300,000. The character of the income to the estate is the same as the character would have been in the hands of the decedent. And here we're going to have $400,000 and $1245 gain, and the balance, or $280, would be capital gain, or $1231 gain. Okay, again, this is going to be treated as an installment obligation. Yeah. Code section 691C is a deduction. And I will say this. 691C says that essentially you can deduct any estate tax attributable to items of I or D can be deducted. Let me repeat that. That any estate tax attributable to items of I or D can be deducted on one's income tax return. And I will say this, for years and years and years and years, the Wall Street Journal, Forbes, and other magazines, newspapers would say one of the 10 biggest misses by accountants on preparing income tax returns is they failed to take the 691C deduction. Okay, that this was a very common error that accountants made in preparing returns, is they forgot to take the 691C deduction. In the year 2018 and going forward, this is not going to be such a big deal, because how many taxable estates do we have? About 2,000 throughout the United States. So there's only 2,000 returns possible that have a 691C deduction. Again, let me repeat, what is a 691C deduction? It's whatever the estate tax attributable to items of I or D, that estate tax can be deducted on the person's income tax return, whoever gets the I or D. So what you have to do is do two estate tax computations. Figure the estate tax with the entire estate, and then take out the IRD and figure out the estate tax without any items of IRD, and that difference is the estate tax attributable to items of IRD. Let me give you a very simple example. Suppose someone dies. Let's keep the estate tax exemption very simple at $10 million, okay? And let's suppose someone dies with an estate of, I'm going to make this up, you guys help me out here with the numbers. Someone dies with an estate of $20 million, okay? And the estate tax exemption is $10 million, and we know that the estate tax is a flat 40%. So the estate tax is $4 million. Everyone agree? Everyone with me? And the decedent had two assets, a $15 million IRA, so I'll write this out. The decedent had a $20 million estate, and they had two assets, a $15 million, and we know the estate tax, by the way, the estate tax we know is $4 million. Everyone agree? And the decedent had a $15 million IRA and a $5 million house. Tell me, what is the 691C deduction? Okay? How much is the 691C deduction? How much?
Did you say the IRA was left with the
4
estate?
million.
$4 million bucks.
4 million
Yeah.
is half,
4.
right?
The IRA is left to grandma, not grandma, I mean, yeah, maybe, no, let me make it different. 4 million, the IRA is left to son. Well, you figure out the estate tax, we know what the estate tax is with the IRD, right? What is the estate tax without the IRD? The estate tax would be zero, right?
Zero.
Because
About
the estate
tax,
would be $5 million, right?
Okay. Is you talking about estate tax or income tax?
Estate tax.
Okay, so
We have-
estate tax
when you
is-
figure out the 691C deduction, you figure out what the estate is with the IRD, and then you figure out the estate tax liability without the IRD. And in this case, if you take away the $15 million of IRD, the person has a taxable estate of $5 million, right? Everyone agree? So the estate tax would be zero. So what's the estate tax attributable to the IRD?
Zero.
Well, 4 million.
Out for the,
By including the IRD, so when the son gets the 15 million IRA, suppose the son decides, I'm going to take out the entire, the son was bequeathed the IRA, the 15 million. You would take the 15 million into income, get a $4 million deduction, and have to report 11 million. On the income tax return. So yes, Alicia, we have two different kind of taxes at play here. We have an estate tax, which gets reported on a Form 706. We have an income tax that's reported on a Form 1040. So you have to do your normal 706 and compute the estate tax liability of $4 million. Then you have to do a dummy 706, right? And you take out all the IRD and say what would be the estate tax. Javier, you were going to say?
I'm good. I'm fine.
You're good?
Yeah.
And then whatever that difference is, that's the 691C deduction.
Pretty important.
It's pretty important, and yesteryear is very important because there were a lot more. There were thousands and thousands of, and many accountants and lawyers missed that. I'm telling you, always was on the top 10 list.
So then,
Because they didn't take masters in taxation as ruggers.
That's right. They did not take their master's degree.
So they-
Little sales pitch here.
We can tell the story at the next conference.
Okay. All right, so everyone's got that? In very simple terms, and if you go through our examples, it, you know, again, I don't think these examples are hard to follow, but I keep telling you, I'm biased. And you guys be the judge. So there's quite a few pages on the 691C deduction. On the next page, we talk about the basic structure. So the basic structure is the actual federal estate tax liability, that's what's actually due, minus a hypothetical federal estate tax liability that would have been liable if all items of IRD and DRD were removed from the estate. Okay? So we talked about who gets, on page 29, who gets the 691C deduction is allocated proportionally to the beneficiaries who get the items with respect to decedent, and that's spelled out. So 3 people where you get, this IRA, each one would get approximately $1,333,333. So, if they split the IRA, there were 3 children, each got $5 million. Each would get 1/3 of the $4 million, right? And then it gets a little bit more I'll call it complicated, about an allocation through a trust or an estate. I went and asked that for exam purposes. Let's look on page 32. Let's do a quick little computation here. Take a look. Assume you have the following information with respect to an estate. Total value of all items of IRD are $16,000, and there's DRD. That's deductions with respect to decedent of $6,000. The federal estate tax is $40,000, and hypothetically, if there were no federal estate, if all the items were removed, the estate tax would have dropped to $36,000. So what's the maximum 691C deduction here, guys? 4,000, right? Everyone agree? Everyone see that? That's the difference between the actual and hypothetical, right? So the answer here is 4,000. Assume that during the year the decedent's child collects all the IRD. What is the 691C deduction that the child can take? What, if any, if the child had only collected 4,000? So let's suppose the child collects all the items of IRD. If the child collects all of it, what would be a 691C deduction? 4,000. And if he only collected 4,000 of the IRD, or 1/4 of the IRD, guess what? You'd only get a $1,000 691C deduction. So and in the case that A collects 4,000 and B collects 8,000, how are they going to divvy it up? A can take 1,000 and B can take 2,000. So let's do this. Let's go through just making sure you guys have a good command of this. This is a problem set I used to distribute to my class last year. So let's see if this works. So what is IRD? Hopefully, well, you guys can't describe it over the Thanksgiving dinner table until next year, but now you guys have other holidays that you can describe IRD, and hopefully you guys know it's income earned prior to death but not recognized before death because of the decedent's method of accounting. As we know, it includes a wide array of things from wages, dividends, interest, all sorts of things. Question B, what basis adjustment is made for IRD items and transfers debt? The answer to that question is there is no basis adjustment. With my authority to put section 1014C, there is no basis adjustment. If an IRD item is included in either gross estate of the transferor or in the income tax return of the transferee or both. So just a little reminder, is IRD included on both the income tax and estate tax? Say what, Alicia? Well, we know, for example, right, that retirement accounts are both on the Form 706, right? And they're an item of IRD. But just to make your notes a little bit more interesting, we learned, right, that a bonus, a discretionary bonus, would not be includable on a decedent's estate tax return because at the moment of death, there was no right to that, okay? So it would not. but it would be an item of IRD. So if your notes, it could be on both, but it may only be on one, right? So I'm just, why should life be so simple? If an item of IRD that is included on the transfer's estate tax return, what adjustment is permitted to that person, to the person that includes it in income, right? If an item of IRD is included in the transfer's estate tax return, what adjustment is permitted? And you know what that is, right, guys? 691C, right? There's could be a 691C deduction. Right? Let's go through these quickly. Which of the following are items of IRD? A, cash met the taxpayer is employed by Corporation X. He's paid once a month on the 15th. He dies August 3rd. His accrued payroll is $3,000. Is that IRD?
Yes.
Yes, absolutely. Suppose he holds an installment obligation, which he received when he sold property to B. The note has a gross profit percentage of 80%, and there is a $20,000 in payments remaining. Is that an item of IRD?
Yes.
Yes. Same as A, except X awards A's widow $10,000, discretionary bonus.
Widow will be
David,
No.
why not?
Because it's discretionary.
But again, remember how the courts have said that. Daniel's estate in the text, the chapter, they read it very expansive in scope. So it
So
would
it
be an
is.
item of IRD.
Yeah.
Yeah. Because they're not paying it, they're paying it because he worked hard. Right?
But
And
she has, like I always think of like entitlement and right to receive.
she doesn't have it, but the courts have interpreted it broadly that the fact they're giving her the bonus creates sort of
Well, it's
bootstrapped
not
it into
discretionary
the-
anymore once you get the money, right? You've got
Say
it.
again?
It's not discretionary anymore once you get the money. Once they say, okay, we decided we're gonna pay you a bonus, well, now it's just like your regular income, isn't it?
But usually at the moment of death, I mean, the way the statute, there seems to have to be a right,
Well,
but
I
I'm
get
telling
the
you.
difference between an actual wage owed, I already worked those days or whatever, but I still feel like once it's sort of like a declared dividend.
Well,
So it is IRD.
it wasn't declared, but I'm just telling you, you guys can read my chapter, there's enough case law to say, hey, it would be an item of IRD. Okay, question D, same as C, except A's contract provided for $10,000 bonus if A dies before his contract expired. And here, David, it would definitely, definitely be an item of IRD.
Now you have clarity because
Well-
you have a contract.
All right,
I mean,
I'm
to
just,
me,
the only
yeah.
difference between C and D is in D, it would also be included on the estate tax return, because that's an actual contractual right. Okay, I'm not testing you on estate tax issues, I'm just letting you know there is a difference in outcome. In C, it's not gonna be included on the estate tax return. Question D, it would be. Question E, when A had an invested amount of $100,000 from a non-contributory qualified pension plan, A's estate received this amount. When A died, he had a vested amount of $100,000 from a non-contributory qualified pension plan, right?
Yes.
Yes, right?
Yeah, this is IRD.
It's all IRD.
You also say who is taxable, like in this case, the state is taxable.
I'm not sure who's taxable, I'm not sure who's getting the money.
Okay.
Question F. When A dies, he also had a non-deductible IRA account of $60,000. A made contributions of $40,000 to the account. Well, whatever amount is remaining, meaning the monies that remain to be taxed in question F would all be taxed IRD, the $20,000 difference. Meaning the $40,000 is after-tax contributions. The $20,000 growth would be IRD. Question G, at his death, A held IBM stock. A stock dividend of $2 is declared on July 20th. The holders of record on August 1st. Payable on August 15th. Well, he's a record holder and he dies. and it's not payable until after his death, is it an item of IRD? Yes, it is an item of IRD. Question H. At his death, A held a 1/3 interest in a partnership K. Partnership K had $360 worth of income. The income for the year, okay, is an item of IRD. Okay, he had a right to that income. And just so you know, it would make no difference with respect to an S corporation. That too would be an item of IRD. This is my friend joking. He wrote a book. Let's ignore the title. He receives a payment of $1 per book for each book sold. Does it make any difference if receipts were in the form of a sale or merely a license? And the point of this question is just to say that royalty payments are IRD. Okay, royalty payments are items of IRD. A owned an apartment building. Prior to his death, A signed a contract that there would have resulted in a sale of $1 million. The contract had a closing on September 1st, and it was subject to the contingency the buyer was able to obtain approval for condominiums. And compare and contrast that to question L. Same as K, except the only contingencies were normal good title considerations. So the point here, or the difference between question K and L. In question K, there was a pretty significant contingency that still had to be satisfied. Okay? So this contract would be considered incomplete. And if the contract is considered incomplete, what code section controls? 1014, right? If the contract is considered incomplete. By way of contrast, if the contingency is not material, right? And the contingency in question L is not material, right? It's just normal good title. Then this would be an item of IRD. Okay, this would be an item of IRD. Everyone see the difference? Question L.
So
between
K is no, L is yes.
I'm sorry?
K is no, L is yes.
K is what?
K is no, L is yes.
K is, there is
Not IRD.
1014, no IRD. L is, it is IRD. Question 3, A sold his principal residence 4 months before his death. His executor excluded income under section 121. Say again?
We're talking about the $500,000?
No? Well, if he sold his residence 4 months before his death, can you use, well, I don't know if the person's married or not, but let's just say the exclusion is $250,000. The answer is yes, right? The sale is presumably complete. The executor can complete the final 1040 and use that exclusion. Question 4, A dies owning an installment obligation for a sale of real estate to B. The balance of the debt at his death is 50%. There's an 80% gross profit. Describe the consequences in each of the following. Is the obligation includable in A's estate? Now, I wouldn't ask that on an exam because, excuse me, this is not a question on transfer taxes, but I will just let you know from your notes, yes, it's includable. Code section 2033. The estate receives a payment of $1,100, $1,000 of principal, and $100 of interest. Well, is the installment obligation an item of IRD? And the answer is yes. So that being the case, just for your notes, that means that, and it has an 80% gross profit ratio, it would be $800 of income, right, of $1,000, and $100 worth of interest. Treated just as if A had received it. So on that in payment, again, there would be $800 of income plus the $100 of interest. Everyone see that? Question 4C. A's will directs the obligation passed to his residuary estate. A's wife receives the residuary estate. And the only point to just illustrate that in this case, this would not be considered a disposition. This would not accelerate the income. So code section 453, capital letter B would not apply. There would be no acceleration here. And authority for that you can see in code section 691, A2 and A5. 691, A2 and A5. Question 4D. A's will directs that the obligation pass to B. Once again, this is not an acceleration event. And do not worry about question 8. There's some funky law about something called a self-canceling
So
note.
C is IRD or?
Yeah, it's IRD, but
IRD.
it's not going to be tapped. It's not going to accelerate.
Right.
The note is not, the transfer of the note will not cause acceleration.
And then D is IRD as well.
Absolutely. Question 5. Individual A was sole proprietor of his dental office. At his death, A owed $1,000 of accrued interest on his loan, the proceeds of which were used to pay off the debt, were used in his dental office. The estate eventually paid the interest in the loan. What are the consequences? And this is just to illustrate, is it deductible to the estate, this payment?
Yes.
Sure. And our authority, just for your notes, code section 691B, right? This is a deduction with respect to a decedent. DRD, DRD, deduction with respect to a decedent. And would the answer vary if the loan were regarding A's principal residence? Would it be DRD? Yeah. Okay, and problem 6 is just a reflection of the problem you just had, so we don't have to worry about it. And the last problem, problem 7, just dealing with joint and survivor annuities. Do not worry about that. All right, do not worry about that. So let me just summarize what you should worry about. We're not worried about it, just make sure. If you get a chance, or when you get a chance, guys, you now have 2 chapters aside from the textbook that hopefully you should have a pretty good, when I say good plan, I don't need you to have the real nuances. If I didn't cover it during the class, I'm not going to ask any questions, but you should know in general what are the various kinds of charitable trust. And then looking back, let me just pause for a second. Any questions that are really bothering you about IRD? Anything come to mind?
I'll ask you later.
You'll ask me later. That's okay. I am around. I'm not going to New Orleans this week, last I checked. I will be around. If you get a chance, rumor has it that you are now getting, solicited to fill out student evaluations. So if you have 2 minutes and you have any thoughts about how you might handle the course differently, that's fine. Let me know. I agree with you that the textbook's a little bit hard, but it's not terrible. I hope you agree. There's not a better one out there. I'm hoping that what I'm putting together will be. You're getting a taste of it tonight. You got a taste of it during our last class. So again, let me emphasize, over the course of the next week, really try to hone in on this. If you have any questions, reach out to me. I will see everyone here on Wednesday, okay? 6 sharp, and I don't know exactly how long the final will be, but it will not be for the full 3 hours, okay? Okay, so have a good night, get home safely, stay warm.